Welcome to Private Lending Insights. I'm your host, Rocky Butani. In this episode, I interviewed Dave Orloff from American Heritage Lending. Dave was my first interview for this podcast. I've had him back on for this episode to talk about DSCR loans. DSCR stands for Debt Service Coverage Ratio. These loans are for long-term rentals, or could be short-term rentals, but long-term loans for real estate investors that invest in properties and hold them for a long term. We talked about specific guidelines that American Heritage Lending offers, and DSCR loans are sort of what you call an institutional type of loan where a lot of the lenders have a similar offering. There's a few things that American Heritage does that's a bit unique compared to other lenders that offer this program. We get into a lot of specifics in this interview about DSCR loans, everything from loan to values, interest rates, loan terms, credit scores, and so much more. American Heritage Lending is primarily a wholesale lender, so most of their customers are brokers and lenders. They have a very small retail division to work directly with borrowers, but the content in this interview is applicable to anyone. It could be a real estate investor, or it could be a broker or a lender. My original plan for this episode was to spend about 30 minutes talking about DSCR loans and 30 minutes talking about American Heritage Lending's wholesale program. However, we spent so much time talking about DSCR, ran out of time, so we're going to have to split this into two episodes. So I'm going to have Dave back in about another 2 to 3 weeks to talk all about their wholesale lending program. I hope you find this episode to be insightful. Let's get started. Here's my second interview with Dave Orloff. All right, Dave, thanks for joining me again for Private Lending Insights. How's everything with American Heritage Lending at this time?
Hey, Rocky. You know, these are my favorite times, is spending time talking shop with you, and you've been such a trusted partner of ours for many years now. So it's always great to see you. AHL's doing great. We were just shy of our all-time record last month in May in terms of both units funded and our funded volume. So we're feeling great. We're really excited. The team's been doing just amazing things. And I sort of wake up and pinch myself every morning. So, yep, we're good.
Yeah, it's amazing. It's again, it's like I said this last time, it's been fun to watch you guys grow, and it seems like you're still growing and doing tons of loans. So good job, and keep that up. So are you seeing anything new in the market? And let's say we last talked in December. Let's talk about, let's say, Q1 or just the last 5 months. Anything new happening in the industry or in your business?
So that's a really good question, because that timing was so relevant. We had just found out who the new president was going to be. And I think there was a bit of the anxiety of the decision of who was going to get elected. You know, I think volume dipped a little bit in Q1, frankly. And I've written that off to people were, done making their bets prior to election, and then they were kind of waiting to place new bets after the election. So fundamentally with product, or with even capital markets and investors, appetites, we've seen no real fundamental change. It's very healthy. Delinquencies are, down, stable. Loan performance is really, really, really high, and investors are clamoring for these loans. And it's neat, right, to be able to serve a market where, traditionally it's harder for them to get loans. It's still a great place to lend, for sure.
And there were a couple of scares with the bond market. Have you seen anything change in the capital markets, or is there's still a major appetite for private lending loans?
So I'm an old guy, Rocky, as you know, and when I got started in non-QM in probably 2018, rates were kind of moving every 6 months, and that's not an exaggeration. And now, whether it's tariff talk or something about bond yields, and Jamie Dimon out a couple weeks ago saying we're destined for a crash, it has been so volatile. I've seen rate sheets change intraday. So it hasn't affected yet. total liquidity in the secondary market for capital markets, but I think people are far more tuned into the incremental adjustments day to day, hour to hour, and eyes are back on the bond, which is a real, work practice from conventional lending. You're staring at that thing all day long, kind of wondering which way it's going to move before you lock your rate. So uh, it's it's become much more of a heightened focus this year.
All right. And how much has pricing changed in let's just say business purpose lending? Have you seen major swings, or is it kind of in the let's say 50 basis points range?
I'd say we're wider of 50 basis points. We sort of ended last year, I would say, in a relatively normal or average rate. The note rates in the sixes. I think we've drifted recently into the sevens again. We haven't touched the eights for the averages, but you can sure sense that, at the borrower level, six has become pretty palatable. Seven is still kind of ugh. So, today, as of this recording, the inflation number came out a little bit tame. So now they're talking, they want the Fed, Trump wants the Fed to reduce rates by a full point. I think if we can get and stay in those sixes and then even trend lower than that into the back half of this year, that's a sign of a really healthy market for the borrower and credit availability, and should be something that lenders can maintain margin, and that whole ecosystem should be able to continue with growth, right? I think it can expand and continue if we see those kind of rates. I think sevens and eights, I'm not as confident about those.
Sure, that would be great if they could hold it in the sixes or even start to trend downwards. So we'll keep an eye on that. Any other trends that you're seeing in private lending at this time? Are you seeing a lot of defaults? Anything else you could tell us?
Well, I think the data is just as new to me as it is to you, and I think we're starting to see very specific pockets. Days on market extend, some price reductions, and I think it's explainable. I mean, there's been some natural disasters, insurance is difficult, rates going up a little bit doesn't help appreciation. And I think for a long while, in private lending, the availability of product and inventory that even an investor could buy at the right price to maintain their margin through their value addition to the property, it just kept getting tighter and tighter and tighter. So maybe this last inning, we were sort of stretching on those after repair values, or we were building, investors were building into the model. I'll have this thing gone in 90 days, such that interest costs, carry costs, those kinds of things, I could still maintain my profit margin. So nothing catastrophic, but certainly we've seen an extension on the time window that, deals are in gestation. And in some areas, maybe they're converting that exit strategy. Like maybe I'll rent this out, or, I need some sort of different strategy for, some type of exit from that investment.
Okay, good. So no news is good news, I guess.
I mean, you know, so far we're working through a couple issues, and I'm sure any lender our size has, but it's nothing that looks to be viral in nature or a landslide or anything even close to that. Thankfully.
Sure. And I'm not saying that increased inventory is not nothing, but or is nothing, but anyways, it doesn't sound like anything major. Normal course of the cycle, if you will.
It seems to be, and I'm always open to hearing other people's opinions as well. But it's been so tight, so long, and these borrowers that are fixed in these 2s and 3%, and they're not moving, and so even like a really healthy situation is sort of underpinning low supply. So anyway, I think the market can absorb that, and maybe the price has to be adjusted a bit, but I certainly think our market is capable of handling increased inventory at stair-step percentages.
Sure. Let's talk a little bit about loan activity. From the data I see with Forcasa, it shows that your loan volume is slightly higher than it was at the same time last year, and it looks like that gap may widen where you'll do a lot more loans by the end of the year than last year. Has anything changed with your offering from what you did last year till the beginning of this year?
Oh.
I mean, you're still doing mostly long-term loans.
Mm-hmm.
A smaller percentage of loans are short-term. Most of it's wholesale lending, right?
Mm-hmm. It's a really good question. I was trying to think if I could give you a really specific answer. We've continued to invest in the team, and we're still a relatively new brand. I mean, we launched our wholesale. It'll be 3 years in August. So extremely proud of that team and their accomplishments. They funded lots and lots of loans last month. Super thankful for our broker partners that made that possible. The retail group, I think you've met some of the new staff members there. So we have leadership there and some new initiatives to kind of focus specifically on the short-term product. But in aggregate, really, Rocky, it was just kind of a stick to our knitting, find great team members, invest in them, surround our arms, put our arms around broker partners and figure out how we can be fast and easy to work with, take out the labor part of the business for them the best we can. And thankfully, they've come back. We're starting to see a pretty healthy repeat business percentage, and that feels really good. So it's very organic versus a shiny new product or tech or something that most companies talk about. It's just been hard work.
Nice. And it looks like last year your loan volume was about 1.1 billion for the entire year, and hopefully this year you could exceed that. And it looks like from the data I'm seeing on Forcasa, is your May loan volume was almost the same as your May 2024 volume, although some of the data takes a little time to come in, but it looks like you're on your way to doing a lot more than last year. So that looks really good.
Thank you. Yeah, we're certainly anticipating more than last year, and we were certainly, budgeting and planning for that was in place, and we have that capacity. That Q1 for us post-election was a little bit funky, as I think most in the market felt, but we are picking up steam, and I think we're going to have a really strong finish to the back half of the year.
Is there anything new happening in the world of DSCR lending? Any new offerings that are offered this year that weren't in the past? Any major guideline changes that you've seen?
Just even 2 years ago, the short-term rental thing was basically taboo, and I'd say now that's pretty accepted, and we have tools by which we sort of, lack of a better word, we can underwrite those properly. The BRRRR strategy, seasoning becomes a big problem and maybe a stumbling block for a lot of investors that are very quick or in a very, very small budget rehab. We've adopted some programs to address that. I think competitive advantage, we have a thing called fee stacking, which we can go into, but it's a really neat way. If you're just a buy, rehab, rent, and then refi, and you're going to stay in that loan for a while, there's certain ways to get a lower interest rate, so you have a lower payment, and not come out of pocket for that. And we've really, really been trying to tell the market about that over the last 12 to 18 months. And then, the loan amounts have actually gone up. So the DSCR cap at most lenders, even 3 years ago, was $750 to $1 million. I'm seeing $2 and $3 million loan amount. It's a small window, but LTVs have gone from 80 to 85 in some cases. So I think just a general expansion of the box is taking place. And certainly markets, securitization, rating agencies, stuff like that, they're starting to understand that this isn't just a no income, loan. I mean, there is underwriting that goes into this, and it's really a commercial loan. And, so certainly every loan is not without its pitfalls in underwriting, but I think there's an expansion of the guidelines, and there's general acceptance at even in the investor base that says, wow, look at the performance of these loans. They're great. They're helpful. And I think it even fulfills part of this American dream. There's still so many of us that want to make a living passively through investing in real estate. It's a wonderful loan program. And I've been a fan for, you remember, I mean, I back in 18, I was telling you, I can't believe it. You can kind of get these loans, set it, forget it, got a cash flow machine, and away you go.
Yep, definitely. And you mentioned the maximum loan to value has gone up to 85%. So let's talk about LTVs in general. In what case would you be able to offer 85% LTV? Is that just on a purchase? And what does someone have to do to qualify for that?
It's a high FICO requirement, and it's a high DSCR percentage. So, and that's hard, right? Because the more you borrow, the higher the payment is in correlation to the income and rents. But it is possible. And I think as soon as market sees more of that, and it performs, in step with the lower LTV stuff, I'm sure they'll kind of lower the restrictions. But you guessed it correctly. So it's a purchase only LTV and a high FICO requirement and a high DSCR ratio. So I believe it's even over 1.25, but don't quote me.
So aside from the credit, it just has to be a situation where the rent coming in is just it's just a hefty amount of profit that they're making compared to the expenses, and that makes sense. But what would be the normal if it's not your more than average DSCR? Even if credit is good, what's the typical LTV at this time? Is it still 80% for most deals?
The majority of purchases are 80. Majority of cash outs 75 at max, and rate and term still, depending on where you go, 75 or 80. So that really hasn't changed in a couple of years now.
Sure. And what about with cash out? Does that typically go down to 70% loan to value?
So no, we'll do 75 cash out, and I guess you're right. Maybe that change was about a year ago. We moved from 70 to 75. So maybe a year and a half. So again, there's some evidence that I think they'll start to widen out the box a little bit.
Sure. And then for people who don't know the term rate and term, because it is kind of a funny term. It's what do you mean rate and term? It's basically where it's a standard refinance and you're not getting cash out. Is that correct?
Exactly. It's a no cash out refi, and we see it pretty regularly in the BRRRR strategy, especially if there's a very cosmetic type of rehab where that investor is willing to pay a little bit more of ARV or whatever, however they calculate what they're looking for in terms of their investment thesis return. There's not a lot left over, but they're looking to get out of sort of a high interest rate, short-term maturity loan and get something fixed that they can get it rented and add to their portfolio of doors under management. We are sort of past beta, and we're probably a week from rolling it out on the rate sheets that we have added a 5 to 10 unit addendum to our DSCR program. So that is something that's brand new for us. I think that's been in market for a while, but we'll have this for multifamily 5 to 10.
Nice. So you've always been 1 to 4 units. Increasing from 5 to 10 units. I've seen that in the market a bit. What's the thinking with 5 to 10 units? Why is it not more than that?
It's a really good question. I think somebody out there has a belief that 10 and up, certainly A markets, Freddie has a really competitive product for that. And so I think they feel like there's this underserved mid-market 5 to 10, and I'm not sure how much of it's out there. Like I said, we have not written one loan yet. It's just coming. But it's been in market, like you say, and I hear a lot about it when I travel and go to conferences. It seems like people are, you know, providing pretty good service and a pretty good volume of loans there. So we'll have to catch back up on the next Rocky Butani podcast here. But we're kind of excited about it. It took a while to develop. You know, it's sort of it's a unique asset, and it's a unique set of documents for a lender to kind of get the right appraisal, get the right loan documents, the right or correct writers. It took us a while to get our heads around some of that compliance stuff, but we're looking forward to launching that here real soon.
Okay. And do you know what the loan to value ratios are going to be for that? I'm assuming it's going to be lower than for your 1 to 4 units.
I believe it's a 5% reduction at all criteria. In any real commercial underwrite, you know, a lot of it has, now you're looking at vacancies and you're looking at expenses and you're looking at some different factors when it comes to an underwrite. But I do think with at least our offering to start, it won't be a dramatic reduction in LTV, maybe 5 points.
Okay. Let's talk about credit scores. Has anything changed with that? What's the minimum in general?
So minimum is still 680 here. I haven't seen much traction underneath that. You know, maybe there's consideration at 660 and to be too far in the weeds when you have borrowers that have high utilization because they're putting their credit card into these projects. It's really understandable. It's not that they've missed payments or they're behind on mortgages or whatever. A lot of times, these new algorithms at the credit bureaus, you know, really penalize you if you have a $10,000 balance available on your card or you have $10,000 out. I've seen it drop scores 80, 90%. So I would say through exception policy here, we go lower, and there's certain circumstances that are very easy to understand. Look, at this person pays their bills regularly. It's just that right now they have a large extension of credit out, and we can get comfortable with that.
Okay. So 680, but does there have to be a certain time that they've maintained that score? So let's say they're trying to qualify for a loan. You know, when you first started talking to them, it was 660, and then you're processing the loan. Now all of a sudden, okay, it jumped to 680. Is that acceptable, or does it have to be some sort of, maybe seasoning's not the right word, but you know, something like that, where they've had that score for a certain period of time and then they qualify?
Our process is so fast, Rocky. We really just look at credit at one time, and that's typically at origination or submission, depending if it's coming in wholesale. There is a refresh process, but I can't even remember the last time we had an or you know, an improvement such that it caused the underlying terms of the loan to change.
Okay, got it. And as far as credit scores, is it still the case that the higher the credit score, the better the pricing, or is it once you have 680 and up, it's the same for everyone?
That's a really good question. So, you know, we call it the LTV FICO grid, and it's just, you know, that's been around for as long as I've been in the business. And it applies to DSCR loans as well. So the higher the LTV you go, you know, the worse rate, and the lower on LTV you go, the lower on credit you go, worse rate. So yes, absolutely.
Sure, makes sense. Okay, let's talk about calculating DSCR. Are there any resources where someone can easily just calculate a DSCR, or anything that you guys have, or anything you recommend to potential borrowers?
I think we've just published it to our website, and if we haven't, we have a little calculator. We're happy to send anybody to do the DSCR Calc, and you know, happy to share that with anybody, whether or not you're doing a loan here. But yeah, we can provide those tools.
And just for newbies, people who are not familiar with DSCR loans, if you could just talk about the calculation in general, what are the main things that are calculated to get to that DSCR?
Yeah, of course. So you take your rent, and that's a convoluted statement in and of itself, but you take your rent on the top and you divide by principal, interest, taxes, insurance, association fees, And those are the ones that come to mind. And so it's just another way. In the old days, we used to say, does it positive cash flow? So meaning, is what you're collecting versus what you're spending, not vacancies and putting a new HVAC unit in or anything like that, but on a monthly basis, are your costs less than what you're collecting in rent? And that's what would make a DSCR ratio positive.
But I think what makes it difficult for people to calculate the DSCR is they don't know what the payment's going to be, right? Because they don't know what the interest rate's going to be. So if they knew what the loan amount would be off of, let's say it's a $300,000 purchase, they put a 20% down payment, then they come up with their loan amount. It's hard to calculate the expenses when you don't know what the rate's going to be, and I think that becomes a challenge. But I guess people have to just reach out to the lender and get a few options, and then they figure out if it qualifies, right?
That's right. And to our previously we were talking about LTV, FICO, grid, and whatever, but we're happy to provide that information and all the different ways you can help yourself, whether that's, there's ways to get lower rates we talked about earlier. So compounding on the questions you've been asking, I completely understand. Trying to find the right rate, to compute the right payment can be more work than just, I'm going to plug in some number and there you go.
Sure. All right. Going back to property types, do you do mixed use properties?
We don't allow mixed use in our DSCR program. We used to say, if less than 25% was commercial in nature, we would allow it. And it just got to be a war of words. So rather than have that be confusing, we just eliminated mixed use.
Is there just not an appetite for mixed use properties in the capital markets that even if you funded one, there's just not enough capital for that product?
To me, I always looked at it more fundamentally so maybe we'll go back to calculation of income. There's a couple ways, and the basic way in a commercial or multifamily underwrite is show me the lease, right? That's what the rent is. Well, as part of an appraisal, for those of you who don't know, I know this is really redundant for those of you that do, you can ask for a rental survey, and it's called a 1007 in the appraisal. And it'll give you a number, right? So for rents, you could pull this thing and it'll say the rent is $2,000. Well, in a mixed use building, let's say there's a hair salon on the bottom floor and there's 2 units above, or let's make it 3, so it's kind of the 25% rule. It just became sort of too interpretive for us to really zero in and have a fundamental analytical tool that said, hey, this is what the rent of this place should be and what expense factor do you put on it. And it started to cross another loan program we have. And so it just got convoluted for us. I'm not saying it is for any other lender, to really underwrite and be analytical and stand behind the decision of, well, this is what it produces and this is the sustainability and this is market. And it just became more internal than maybe what capital markets does and doesn't have an appetite for us.
Sure, that makes sense. The valuation could be definitely a challenge. The potential rent could vary by a wide margin, and then also the space could be vacant for a while. They're not as easy to rent, so that kind of makes sense that they're just a little more difficult, and why bother with them?
Well, and then you waterfall into, do you have to check zoning and then, is it grandfathered or non-conforming? And then, what happens if the next investor won't buy it because it was some sort of environmental stuff? And it just put us into this box of, wow, it's not that we can't get comfortable with that or underwrite all that, but there's so many more considerations we hadn't thought of. It was easier to say, all right, we're going to stick to our knitting over here, and we're going to do these single family 1 to 4. DSCR is pretty easy to calculate, and it's industry adopted process. We're going to go do those.
Yeah, I'm sure there's some lenders out there that do them because there's a lot of these types of properties in major densely populated cities like New York, Boston, San Francisco, and they have to go somewhere to get their financing. But yeah, it makes sense. There are some complexities to those. All right, let's talk about loan terms. So I've heard from maybe some brokers over the years, or I don't know where I heard it, but I heard that you guys do a 40-year loan term, whereas everyone else does a 30-year term. What's the deal with the 40-year term? Is it offered to everyone? Is it easy to qualify for? Tell us more about that.
We do. It's another niche that we offer. It's a 40-year term. First year, 10 years are interest only. The remaining are at 30-year fixed, and it helps as intended. So if you're trying to maximize cash flow by removing that amortizing principal payment every month, that goes to the investor, meaning the real estate investor. And so it's fairly easy to qualify for. I think you have to have a 700, maybe even 720 FICO. But in terms of qualifications, it's actually kind of easier because it's easier to DSCR property. It's easier on the cash flow for the borrower. And it's a very popular program for those that it doesn't even have to be speculative. But if I come from a philosophical orientation that over a very long period of time, real estate's always gone up, and I'm not necessarily concerned with some orientations that are, I'm going to pay this thing off and there's my retirement. It's just going to come to me every month. There are a lot of investors we work with that really enjoy the stepped up cash flow from day one.
And what are the downsides of getting a 40-year term? I mean, why would someone pick 30 instead of 40?
I think that's a really great question. I have this saying in the office, and I hope it's not misinterpreted as it goes out to the world. But finance is a religion, and I think it's just everybody has their beliefs, and they're all fine. I think you just have to decide that there's definitely a classical conservative approach to investing. Is the sooner I can eliminate my debt, the better off I am. I have more equity, right? And then certainly no debt means I get all the cash flow. Well, I think there's also maybe a different orientation, aka different religion, that says I want maximum cash flow from day one. Even so much so as I see my property or portfolio appreciate, I'm going back in and refinancing and taking that to go do more with the money. And neither is right, neither is wrong. But I can see how both loan programs would appease one and probably frustrate the other. So that's why I've kind of coined it finances like religion.
I like it. And you mentioned that the first 10 years, the payment's fixed and then it's amortized for the remaining 30. So from a real estate investor's perspective, their payment is going to be the same for that first 10 years. Is it going to change, or is it just the amortization has changed?
It'll be interest only for 10 years at whatever note rate we fund the loan at.
Okay, so it's not like their payment's going to jump after the first 10 years.
Nope.
All right, that's amazing. And how about rate locks? Once someone gets a quote from you, do you offer a lock period where they're guaranteed to get that rate?
So this has been sort of new to non-QM, but in 2021 we had our first kind of rate move, and certainly we had it in late 22 and 23. We've always had a 45-day rate lock as standard, and we still offer that on all our programs. So if you're happy with the rate you see, you lock that in for 45 days and not subject to market.
Okay, so if interest rates go up within that 45-day period and they decide to move forward, then you're essentially just taking a loss because you offer that lock period. Is that right?
Yes.
I mean, hopefully not, but in theory.
So theoretically, yes, it's at the risk of us, but in the back office, our capital markets group are trying to hedge as best we can our position that we can deliver, such that we don't actually have a financial loss, but that yes, there would be a market, yes, it's too difficult to explain, but we do hedge that interest rate risk.
Okay. And what if someone locked in a rate and then rates come down? Can they easily just say, hey, I need a new rate, or are they stuck with that rate that they locked?
So it's called a float down policy, and we do look at them from time to time. In this market, you'd expect that we're going to see some of that unless this tariff talk and all this other political stuff starts to mellow out. Float down non-QM is really difficult, and this is probably a conversation for my cap markets group, not me, but it's really hard to hedge non-QM. There's not like an MBS that it says non-QM to it. And so it's really hard for all of us lenders to offer float down. So I think what we try and do is be fair. If we can do it and it doesn't mean we're writing a loan at a loss, and it can help our clients and it can help our brokers and it can help our partners, we do lean in. It's just, it can't be programmatic. We don't have a way to say, oh, market's better by an eighth, take our whole pipeline and relock it. Nobody lets us do that. So it's kind of an individual case by case situation.
And at what stage of the process do they make that commitment to lock the rate? Let's say you send them a term sheet and they sign it. Is that at the time that the rate's locked?
So our brokers are allowed to float until it goes into underwriting. But if a broker's going to commit, like, hey, here's the situation, here's the loan scenario, I think it looks great. We say, hey, it seems to pass the smell test. Let's get it into underwriting. We usually ask, for your safety and ours, make sure the borrower is agreeable to the terms. You've got the right fees and your compensation built in. Lock the loan, get that confirmation, and then let's get it in underwriting and start the process.
Okay, got it. So even if the process takes about 30 days to close, they're still getting that rate that you committed to 30 days prior.
Absolutely.
All right, and let's talk about, well, since you mentioned entities, what if the LLC, for example, has multiple members? Let's make it easy and say there's two members. Mm-hmm. How do you qualify them? Is it do both of them have to qualify in terms of credit score and other financial situations?
So the way we look at an entity structure is any guarantor who owns 25% or more should be vetted. So in your situation, 50-50, we would vet both guarantors, and then we would use the highest from a credit perspective for the pricing and the qualification.
So if let's say one of them has credit challenges, they have a credit score of 650, and then the other one has a credit score of 700, are you just ignoring the one with the lower credit score and you're still qualifying it based on the person with a higher credit score?
Theoretically, yes. I mean, if there's credit challenges, not just utilization or something like that, yes, we're okay. Going to use the 700.
And then same thing, if it's three members of the LLC, you just take the highest one.
Mm-hmm.
Okay, great. All right, let's talk about short-term rentals. You mentioned this earlier that short-term rentals became part of the DSCR offering several years ago. There's enough data out there for a lender to see what the potential rent could be in a certain area. Has anything changed lately in terms of short-term rental DSCR loans?
Well, a lot, I think, and it's all like this this opinion and maybe sort of a risk approach to it, and so when it got started and everybody said we're not doing short-term rentals, they really came from a place of regulation, right? So these cities and counties were against it. They were blocking it. A couple people got these grandfathered opportunities where they could kind of license them through the city. Then those were repealed. And so in the beginning, it was such a regulatory nightmare. I think lenders just said, we're out, we don't want to participate in being part of something that its revenue is at risk, the business operating model. And I think over time, if you fast forward all the way to today, there's probably more risk in a combination of saturation. Now in certain areas, everybody's Airbnb or VRBOing their property. So the amount of rentals and the per night charge is coming down such that the overall income's coming down, along with maybe people aren't traveling like they did post COVID. So I think what you're hearing and what people are talking about is, wow, does the economic justification still exist that these bring in so much revenue? Why wouldn't we lend on them? Now I think they're becoming more commonplace, lower revenue, lower margin, more commonplace, and nothing's changed, right? A guideline hasn't been affected. We're not taking a second look, but it certainly strengthens a borrower's position when you see that they've owned and operated one for more than 12 months. It tells us that, okay, you've lived through sort of the months that are good, the months that are bad. You understand you're going to have some periods where cash flow is not going to be great. You make it up in the holidays or whatever, if you're seasonal or whatever it is. But I think as time goes on, the regulatory risk currently has been subdued, and now I think it's more they're just looking at these from an economic perspective.
So does the investor need to have experience and have operated a vacation rental or a short-term rental prior before they can qualify for a DSCR loan?
At our company, they do for sure, and I'm assuming that will become pretty widespread if it isn't already. It's just it makes sense because they take a while to, build up clientele, and it's just like any business. It takes time to get it working, and if you don't have great reserves, you're not in it for the long term, or you don't understand that kind of, when you plug in your pro forma, you're going to get this number, and when you come out day one, you're going to be operating at this number. That's kind of a problem.
And what if it was a situation where someone operates a few rentals in one area? Let's say they're in Gatlinburg, Tennessee. They operate 3 vacation rentals there. Now they want to go buy a house in Nashville, and it's a totally different market. How do you factor the experience in that case?
So we see it as like experience. So if they're in the we don't even do it by night, but if they're in the $400,000 property range in Gatlinburg, and they're in the $500,000 property range in Nashville, and it's kind of the same occupancy data that we're getting out of the sites that we use, it's fine. We're not very, very hyper focused on the geography.
Okay. So bottom line is if they've never operated a vacation rental, they're going to have to operate it for about a year before you would consider giving them a DSCR loan.
Yes.
Okay. And are the loan to values typically slightly lower in the case of vacation rental or short-term rental versus long-term rental?
Mm-hmm. No, because if they, again, where they started, the use case and the justification for doing it as an investor, real estate investor, is, boy, these produce a lot more return. Sure, I have to furnish them, and sure, I have to pay some marketing and expenses and what have you. But boy, if I do that, maybe I get a 30, 40, 50, 100% lift on what I would get if I put a long-term tenant in there.
All right. Now let's talk about fee stacking, which you mentioned earlier. So what is fee stacking, and how does that factor into getting a DSCR loan?
So we've developed a way where basically you can finance discount points. So if you came to me and said, Dave, I don't like that 7.5 rate, but I love the 7 rate, and I'm willing to pay a couple 3 points to get it down there. In a traditional sense, that's fine, but I have to charge you for those discount points. And we've said, well, okay, tell you what, Rocky, I've got a special for you today. We'll take that amount that would be required to buy that loan down, or buy that rate down, and add it to the loan amount. So it's just a way that it's a non-cash charge for helping you with a lower interest rate.
Interesting. And so in that scenario, you've got 7.5 as the quoted rate. They want it at 7%. What would the fee be like in that scenario? Is it and how does it vary?
So it varies all the time based upon securitization and secondary markets. So sometimes it can be 3 to 1. Sometimes it can be 4 to 1, depending if you're already at a really low rate. But call us. We have it on a spreadsheet. It's very easy to calculate, and it's just a really nice way that borrowers can get lower rates, and then our broker partners that do charge origination fees, we allow them to stack those fees as well, which is just incredible. So, the net effect to originating a loan at a borrower's level when they're working with our broker partners is they don't have to come out of pocket or reduce their cash back. In the case of a cash out loan, they can add it to the loan balance.
So it would just increase the loan balance and it would increase their monthly payment as well, right?
Yeah.
Okay. And hopefully at an amount that's not too significant where it kills the deal.
It's pretty minor. It's pretty minor. Yeah.
Okay, great. And last thing about DSCR loans, let's talk about prepayment penalty.
Mm-hmm.
Are those still typically done on a step-down basis of 3-2-1 or 5-4-3-2-1?
It's funny how we get so sophisticated. Many years ago, it was just a 3-year 3-2-1. And then they're starting to get variations. We offer and price everything from a 5-year 5% fixed all the way to a 1-year 5% fixed, or I think the lowest it goes at 1 year is 3%. So we have all different kinds of variations.
So if I wanted to get a DSCR loan, but I think that rates are going to come down in a year, I don't want to have that prepay penalty. Am I just going to be paying more points to get that 1 year prepay?
Not necessarily points. You'd have a higher rate, but yes. So the lowest possible outcome for a loan from a fee perspective would be a 5-year prepay, and vice versa. The higher would be a 1-year prepay.
So with DSCR loans, a lot of people that come to our site and submit a loan request and they ask us for recommendations, a lot of times they're rejected because of the location, and it's outside the metro area. It's too rural. Do you have any guidelines on the location of the property that most people can use to say, hey, this is going to work, or it's just not going to be possible?
So I have a funny one. I have a legitimate tool, and then I have what everybody tries. The MSA count of the major metro, they like to say it has at least 10,000 people in it. And then, the cascade of that is, what is the city population there? And if it's, less than 4,000 or 5,000, it's probably rural. The fun one is, and I actually had an underwriter, not of this company, but I had an underwriter tell me this. If you put in the location of the property and you can drive to a Starbucks in 5 miles, it's not rural. So I really like that one. And then there's a tool, as long as it's still available and their site doesn't go down, it's the CFPB Rural Check. And I know it's for USDA loans and whatever, but it's just, if you're triangulating and trying to figure out, is this property too rural, it just says yes or no. And those are kind of the ways we look at it, as well as, we use Google and we zoom in and it's in the middle of a forest. It's probably too rural. Has gravel or dirt roads. It's probably too rural. But then the classical appraisal definition of that would be, if there aren't 3 comps within 5 miles, it's definitely rural.
Okay. So as long as you could comp it out in terms of figuring out what the rent could be, then it should be fine. So it's not necessarily a factor of hey, it's in the small town, population's 20,000, but it's about an hour drive from a major metropolitan area. Like it's an hour outside of Dallas-Fort Worth metro, and there's no airport nearby. So theoretically, that location might be okay as long as there's comps.
It might be okay, and then you really get into the specifics of what's the marketability, who would be renting this place, where are they working, what is the story behind, why this place way out in the middle of nowhere would be a highly desirable rental. But yeah, I mean, if it's a city of 20,000, there's a pretty good chance it's probably going to comp, and it's probably a loan we could do.
And you mentioned the number 10,000. So an MSA that has 10,000 people, that could still be a possibility. It's just kind of far away from a major city.
MSA is a really weird thing, as if you've ever looked at them, sometimes they're, like, in Irvine, I might be, I don't know, I've never really looked, but it might be like the LA MSA. Well, I'm an hour drive from LA. So, and then sometimes the MSA is like that little city and county. So it's another one of those, which way is the wind blowing measurements, as is the CFPB rural thing, as is the Starbucks rule. But, some dead giveaways are there's a house in the middle of nowhere and it's on a dirt road. And like you said, it takes 40 minutes to drive there from a grocery store. It's probably rural.
Okay. And what about land size? What if it's they call it a ranch or whatever? It just has a lot of acreage. Is there an acreage limit for a DSCR loan?
Our limit's 5 acres. We can and have made exceptions above that. And I think that's another good tell. Although there are some places that, land isn't, the style of living is not necessarily that it's a ranch or they raise and farm different types of, animals, vegetables, whatever, that are doable. They're just more of an estate type property, but they still present as a rental property. And, maybe there's some mitigants people would take in terms of LTV and stuff like that. But acreage in and of itself isn't a disqualifier.
All right, Dave, that's all the time we have for today. I really wanted to talk about your wholesale lending, but we've gone almost an hour just focused on DSCR, so I'm going to have you back. We're going to try to do another interview in a couple weeks, and we'll have that focus just on wholesale lending, because that's kind of the bulk of your business, and it's a really good program from what I hear. So we'll have you back on to talk about that shortly. So
I can't wait. You know how much I enjoy these things. Thank you again. And I look forward to seeing you here in a couple of weeks.
Sounds good. And that's a wrap for this episode of Private Lending Insights. American Heritage is listed on privatelenderlink.com. I'll put a link to their profile in the description. Visit their profile to learn more about their guidelines. Obviously, you learned a lot about their DSCR lending guidelines, but you could find out about other programs that they offer, and you could find their contact information on their profile. You can call them, you could send them a short email form, or you could send them a long loan request form. When you reach out, please mention that you heard about them from LenderLink and the Private Lending Insights podcast. American Heritage Lending has a popular wholesale lending program for brokers and lenders throughout the United States. So if you originate loans, you're going to want to stay tuned for that next episode. I'm going to interview Dave Orloff again in the next 3 weeks or so. And that episode is going to focus 100% on wholesale lending. This is my last interview from this office on O'Toole Way in San Jose. We're moving to a new office just a few miles away from here. I need about a week to get that set up for podcasting, and then we'll start back up with our next interview the last week of June. So if you're watching this content, you'll see a different background in future episodes. That's all for today. Thank you for tuning in and listening all the way to the end.